2009, back from the brink. It sounds like a movie title. It really describes the financial markets. Mortgage securities, municipal debt, they've surged in recent months as it appears the U.S. economy has avoided depression. There is still one major market that continues to be locked up, however. I'm talking about auction rate securities. 18 months after investment banks quit supporting the securities, more than 400 companies are stuck with $22 billion worth of the debt. And according to the New York brokerage firm Second Market, the securities are selling at losses of as much as 40 cents on the dollar. So joining me now to talk about this is Anthony Carfang, partner at Treasury Strategies in Chicago. His firm advises companies on working capital management strategies. Thanks for being here, Anthony.
Oh, you're welcome.
Everyone else is bouncing back. Why can't the auction rate market have a recovery similar to the other kinds of distressed debt?
Well, the buyers and sellers are still on the sidelines. The buyers have a stigma associated with auction rate securities and are currently very conservative and don't want to buy a very complicated instrument, which an auction rate is. The sellers, on the other hand, companies who already own these, for the most part have reclassified these as long-term securities, and we're advising our clients to stick with them and wait for a liquidity event that we think may happen sometime in the next couple of years.
So that's how you think a market for them would develop?
Right. Our clients feel that many of these securities are very high in terms of credit quality. The problem is liquidity. And because the credit quality is so high, in fact, in some cases, these are guaranteed student loans by the federal government, our clients are reluctant to go to some of these secondary markets and sell these securities at a loss.
So how can companies work it so they at least get some of their value back?
Well, right now, some companies have put these in the long-term category, and they're simply holding these for the duration. Other companies who need cash, some have been able to work with the underwriters who sold them the securities in the first place and have worked out borrowing arrangements where the underlying securities are collateral for loans. Those are usually the most extreme situations. Most companies who have the staying power are simply sticking with them.
How optimistic are you then that the banks will make a real dent in buying back the $22 billion in auction rate securities on the books of corporate holders?
Well, we'll know in another year when the legal agreements require them to use the best efforts to buy these back. We actually think that many of the issuers, even before that, will want to redeem some of these. As interest rates rise, the penalty rates on these auction rate securities will damage the issuers, so they will have an incentive to refinance. In addition to that, Wall Street is already working on a number of ideas to convert these securities into other instruments that will give corporations liquidity. So again, we tell our clients, if you have the staying power, there is no rush to sell these at this point.
And those clients, I bet, have been having sleepless months. What have they been telling you?
Well, in 2008, they had sleepless months. Finally, at the end of 2008, when they completed their annual financial reporting, they pretty much put these to bed. They reclassified them as long-term securities, and they're hunkering down and running the rest of their business. There's an awful lot to keep them awake these days.
Okay, well, thanks for sharing this with us, the advice that you give to your clients. Anthony Carfang of Treasury Strategies in Chicago. Auction rate securities aren't the